Pet Valu, TFX ticker PET, just beat consensus on both the top and bottom lines for Q2. I mean, revenue came in at 290.7 million Canadian dollars, which edged past the 289.2 million estimates.
Right. And adjusted EPS hit 41 cents, comfortably beating the 35-cent consensus. Plus, management reaffirmed their full-year 2026 guidance.
Yeah, they're calling for, what, 2 to 4% revenue growth?
Exactly. That and an adjusted EBITDA margin of roughly 21%. But, I mean, you have to look at the stock reaction. Shares spiked over 11% on the headline beat, but then the market just violently faded that move.
Completely round-tripped.
Yeah, sliding right back near its 52-week lows, trading in that $19.50 range. We really need to unpack what's driving that massive reversal.
Well, the surface-level numbers look great, but parsing through the actual earnings report, this kind of reminds me of a duck on a pond.
Oh, smooth on the surface.
Exactly, but paddling furiously underneath just to keep margins afloat. The profitability metrics were really doing all the heavy lifting here. I mean, gross margin widened to 32.5%.
And adjusted EBITDA margin hit a really strong 22.4%. That is a full 100 basis point expansion year over year.
Which is huge. But how did they get there? Because it seems like they achieved that margin expansion mainly through, well, just very strict cost controls.
Yeah, cost controls and some very specific supply chain efficiencies. Management rolled out these new labor and transportation management systems. So instead of just general belt tightening,
Just hacking away at budgets.
right, they're actually dynamically scheduling warehouse labor to eliminate idle hours. And they're optimizing their freight routes to burn less fuel per delivery.
Oh, wow. So getting really into the weeds on efficiency.
Yeah, and you add in some corporate store resale gains, plus solid digital demand from, click and collect and auto ship subscriptions, and that's how you get that margin bump.
I have to question the quality of these earnings, though. I mean, as an investor, you have to ask if this margin expansion is just financial engineering masking fundamentally weaker store economics.
You think they're cutting into muscle?
Yeah, because a retailer can only cut operational fat for so long before it starts degrading the brand experience, right?
I'd actually push back on that a bit. The data doesn't really support the financial engineering theory here.
Wait, really?
Yeah, because the new distribution centers and those automated management systems, they provide a permanent structural reduction in operating costs.
So it's fundamentally leaner infrastructure.
Exactly. It's not some temporary accounting trick. The reason the stock couldn't hold that 11% rally actually has nothing to do with the quality of the cost cuts.
Let me guess, it's the top-line vulnerability. Customer foot traffic.
Bingo. Same-store sales actually declined by 0.2%.
Yikes. Because all the structural supply chain efficiencies really don't matter much if the core customer base is visiting less often.
Right, and transactions fell 1.4%. There are simply fewer people walking through the doors of their mature stores. The overall revenue growth was basically entirely rescued by two factors.
Which
An average ticket size increase of 1.2% and the addition of 7 new store openings in the quarter.
So wait, are they just squeezing more juice from fewer lemons? I mean, masking the declining foot traffic by simply charging the remaining loyal customers more per visit.
That is a very accurate way to put it, yeah.
Because depending entirely on higher average tickets and a larger store footprint to offset shrinking transaction volume, I mean, that is a highly risky long-term strategy for anyone holding this stock.
It is. And management pointed directly to cautious consumer behavior on the call. They noted that rising fuel costs and broader economic pressures are forcing trip consolidation.
Right, so devoted pet owners aren't necessarily abandoning the brand.
No, they're just stocking up less frequently, shifting their purchases to promotional periods, maybe trading down a little.
So the existing customer is spending slightly more per trip due to pricing power, but the velocity of those trips is dropping. It sets up a critical dilemma you have to mull over when modeling this out. How long can structural margin expansion and new store bills paper over a flatlining same-store transaction trend?
It's the million-dollar question. I mean, cost cuts give you a fantastic runway, sure, but eventually retail survives on volume.
Right, you need more feet walking through the door, not just higher price tags on the shelf.
Yeah, the margin buffer is real, but organic traffic is the only sustainable engine for long-term retail success.
Absolutely. Well, thanks for tuning in to this deep dive into Pet Valu's Q2. Make sure you follow the show for your daily earnings coverage.